Welcome back to the Deep Dive. Today is Wednesday, January 28th, 2026. If you're listening to this on your commute or at your desk, you might want to check your pulse. Because we are standing on the precipice of what our sources are calling a monumental week for global finance.
Honestly, monumental might even be an understatement. It feels heavy out there, doesn't it?
It really does. I mean, you've got the FOMC meeting, a massive slate of big tech earnings, and shifting liquidity cycles all colliding at the exact same moment. It feels like the calm before the storm,
Right.
or maybe the calm before the rocket launch.
Or the calm before the rug pull, depending on your time horizon. We have a huge stack of market situation reports to get through today.
Yeah.
And the core thesis here is, well, it's a bit unsettling. It basically argues that the stock market, as you learned about it in textbooks,
Broad, diverse, representative of the whole economy.
Exactly, that it doesn't really exist right now.
Yeah. I was reading through the notes, and one line just jumped out at me. The report explicitly states we have shifted from a market of stocks to a market of 5 stocks.
Right. And that distinction is everything.
Which, it sounds like hyperbole. It sounds like something you put on a YouTube thumbnail to get clicks.
Sure.
But then you look at the actual weighting, and it stops being a slogan and starts being a math problem.
The math is just undeniable, and that is our mission today. To unpack why the Nasdaq Q and S&P 500 are finally breaking out of the 76-day consolidation, what on earth a rainbow pattern is, and why it matters for your portfolio, and also why there might be a death zone waiting for us in late February.
Let's start with this market of 5 idea, because I think people hear concentration risk and their eyes just glaze over. They think, yeah, big tech is big. But the numbers here are just staggering.
They are. Look, the S&P 500 is supposed to be 500 companies, right? That's the whole pitch. But the data shows that the top 10 companies in the index now make up 48% of the entire aggregate weight.
Almost half the market is just 10 boardrooms.
But it gets even crazier if you drill down. It gets even tighter. The big 4, so Microsoft, Apple, Google, and Amazon plus NVIDIA.
Just those 5.
Just those 5 companies make up 50% of the total weight.
So literally half the market is just 5 balance sheets.
Precisely. And the report makes a very blunt, almost rude point here. The other 495 companies in the S&P 500, they're now effectively noise.
Ouch. I mean, imagine being the CEO of company number 496. You're busting your back, delivering value, increasing margins.
And you're just a rounding error.
Yeah, the market algorithm just treats you like a rounding error.
It's brutal, but as a trader or an active investor, you just have to accept that reality. It changes how you trade. You have to stop looking for market breadth.
Which was the old way, right? You wanted to see everything rising together.
Right, that was the sign of a healthy rally. Now forget it. You need to be looking for hyperscaler health. Index direction isn't about broad economic sentiment anymore. It's a direct reflection of these specific giants.
The report actually gives a really concrete example of this. It mentions that when Microsoft bottomed recently on a Tuesday, the Nasdaq bottomed in lockstep.
It's the engine. Microsoft isn't just a participant, it's the pace car. And right now, that engine is revving. The Nasdaq Q is transitioning from a period of sideways frustration, that 76-day lull where everyone got bored, into a phase of vertical expansion.
And we have a specific target for this, right? I saw the number 26,950 in the notes.
That's the big release. The target is specifically mapped at 26,950. For the technical nerds out there, that is the 1.272 Fibonacci extension level.
Okay, so ELI 5 that for a second.
Right.
Why 1.272? Why not just the old high?
So Fibonacci extensions are used to predict where price will go after a breakout. The 1.272 is a common psychological target. Essentially, when you break out of consolidation that has lasted this long, over 2 months of chart, you don't just stop at the old highs, you blow past them.
Because all the people who are waiting on the sidelines suddenly have to chase the bus.
Exactly. That wait-and-see capital suddenly becomes fear of missing out capital. It creates a vacuum upwards.
Speaking of blowing past levels, let's talk about the S&P 500 in this rainbow pattern. Now, I'll be honest, when I hear rainbow, I think of Care Bears. I think of something gentle. But the report calls it a coiled spring for volatility. So paint the picture for us. What are we looking at on the chart?
It's a rare, highly specific technical alignment. A rainbow pattern occurs when the monthly open, the weekly open, and the daily open prices are all stacked tightly on top of each other.
Okay, so usually those are spread out.
Right. I mean, usually the monthly open is way down there, the weekly is somewhere else. But right now, visually on the chart, you see the lines, yellow for monthly, red for weekly, green for daily, just compressed into this super narrow range.
And in market physics, compression equals potential energy.
Bingo. It means the market has been squeezed tight. It signals extreme price consolidation and usually precedes an explosive move. And the fascinating thing is, we got the trigger earlier this week. You remember that gap down on Sunday?
Yeah, I remember opening my app and seeing red immediately. It looked pretty scary for a second.
It was orchestrated.
Orchestrated. That sounds a little conspiratorial.
Well, let's say engineered by the mechanics of the market. The S&P 500 gapped down to tap the yearly open at 6,864 with absolute precision.
Wow.
It didn't just touch it, it formed what they call a bullish order block.
Okay, break that down. Bullish order block. We hear that term a lot on Twitter, but what does it actually mean in terms of money changing hands?
Think of it as a footprint of institutional money. Whales banks, hedge funds, they don't buy on an app like you or me. They place massive orders that sit at specific levels.
Okay.
So a bullish order block has three characteristics. First, the location. In this case, it defended the yearly open. That is the psychological floor for the 2026 bull case.
If we break below the yearly open, the year is red and the whole psychology flips.
Exactly. Second, it was a liquidity sweep. It dipped just low enough to take out the stop losses of the previous candle. It trapped the shorts. All the people who thought the market was crashing, they get trapped. They grab the liquidity from the panic sellers.
Right.
And third, and this is the most important part, it engulfed the previous candle completely. The price shot up higher than it started. It was a massive neon sign saying that institutional buying stepped in exactly where it needed to.
So the rainbow pattern provided the energy, and that defense of the yearly open was the spark.
It is arguably the most important technical setup of the quarter. It's the green light for massive expansion.
All right, so the indices are primed. But let's go back to our thesis. If this is a market of 5 stocks, we can't just buy the index and go to sleep.
No.
We need to look at the specific players. The report calls Microsoft the canary in the coal mine. Why Microsoft?
Microsoft is leading the charge because it's the first to recover. It had a rough patch recently, a deep pullback that the report calls unpleasant for a lot of retail traders. But structurally, if you look at the chart, it was just filling a gap on the 3-week chart. Since then, it's executed a classic V-shaped reversal.
There is a tactical note here for traders, though. It mentions an inside monthly candle.
Right. This is crucial for anyone trading the QQQ. Your primary screen shouldn't be the Nasdaq Q. It should be Microsoft's daily chart. We need Microsoft to close the month strong.
And an inside monthly candle just means the price action is contained within the previous month's range.
Yeah, it hasn't broken out yet. Not fully. If it fails to break out, if it weakens into the end of the month, the whole index rally could stall. It's a confirmation signal. But if it holds, we are looking at a target of $553 to $555.
Then there's Amazon. The report calls it the sleeper, and arguably the Google of 2025. Now, Google had a monster run last year. Is Amazon really positioned for that kind of move?
The argument is that it's just being ignored. While everyone has been chasing NVIDIA and AI chips, Amazon has been consolidating for 7 months.
7 months of doing nothing. That's painful to hold, just dead money.
It feels like dead money, but technically it forms a massive triangle pattern. It's just been building potential energy this whole time.
And earnings are coming up. Does that worry you? I mean, usually earnings are total coin flip.
That's the interesting part. The report argues that the chart is so coiled that the earnings result beat or miss almost matters less than the technical setup.
Really?
Because of that 7-month sideways grind, the RSI, the relative strength index, is neutralized. It's not overbought. It has massive room to run. They're projecting a 20 to 30% rally, targeting $300 to $360.
That is a huge move for a company that big. A 30% move on Amazon adds, what, hundreds of billions in value?
It's a catch-up trade. It's undervalued relative to the AI infrastructure and the robotics advancements they're making in the warehouses. The market just hasn't priced it in yet because it's, boring compared to NVIDIA.
Speaking of boring becoming exciting, let's talk Meta, the laggard to leader.
Meta has been undergoing what they call silent consolidation. While other stocks were whipping around, Meta was just quietly printing a bullish engulfing candle on the 3-week chart. And the thesis here is simple. Money never stays in a fixed place. It flows from the parabolic runners into the consolidators.
So as NVIDIA gets too expensive, the smart money rotates into Meta.
Exactly. It's a value play within the growth sector. The target there is the previous highs of 788. It's an investment-grade setup, not just a day trade.
Okay, you mentioned NVIDIA getting expensive. This brings us to the part of the outline that actually maybe sit up straight. The death zone.
Yeah. This is the timeline you need to tape to your monitor.
It sounds ominous. What are we talking about here?
The report breaks the next 30 days into two very distinct phases. Phase 1, which is right now until roughly February 13th, is the melt-up.
Oh.
You want a long bias. You want to be aggressive.
Ride the rainbow.
Ride the rainbow. But Phase 2, starting around February 20th, that is the death zone, the advice shifts to going neutral or completely risk-off.
And this all centers around NVIDIA again.
It draws a direct parallel to the January-February 2021 cycle. The expectation is that NVIDIA rallies into its earnings on February 25th, maybe tagging $211 or $212.
Okay.
Everyone gets euphoric. Your Uber driver starts asking you about NVIDIA call options.
The classic top signal.
Right. But that earnings event is likely a sell the news moment.
So buy the rumor, sell the fact.
It's about liquidity neutralization. The market runs up to take out the highs, gets everyone frothy and excited, and then it reverses violently to take out the lows on the other side. You do not want to be the person buying the top of the NVIDIA earnings hype in late February.
But there's also a structural reason for this timing, right? It's not just vibes. It has to do with stock buybacks.
This is the hidden mechanic that retail traders often miss, and it is the single biggest engine of modern markets. The cash cows, Microsoft, Amazon, NVIDIA, they have their buyback windows opening the first week of February.
Explain that to the listener who might not know the rules on buybacks. Why now?
So companies can't buy their own stock right before earnings. It's basically inside information. But once earnings are out, boom, the window opens, and they have authorized billions of dollars to buy their own shares.
So they enter the market as a guaranteed buyer.
A massive price-insensitive buyer. They inject this capital, creating a floor and an upthrust in momentum. This seasonality peaks around February 13th.
Okay.
But then, and this is why the death zone exists, as we get into March, that demand just dries up.
Why March?
Tax liabilities. Large players often take profits to cover tax payments due in March and April. Plus, the corporate buybacks pause or slow down as they exhaust their quarterly limits. So you lose that artificial support right around the time the death zone kicks in.
That is fascinating. So the corporate treasuries are basically fueling this phase 1 melt-up.
They are the whales. And when the whales stop eating, the water gets very choppy.
Now, there is another catalyst mentioned that's completely outside the U.S.-Japan.
Yeah.
We've got an election coming up on February 8th. Why does a vote in Tokyo matter to a tech trader in San Francisco?
Because of the yen carry trade. This is the plumbing of the global market. The report calls it the slush money fueling the rally.
Okay, this is a concept that always confuses people. Remind us how the carry trade actually works.
It's basically arbitrage. Investors borrow money in yen because interest rates in Japan are incredibly low, basically zero.
Right.
They take that borrowed yen, they convert it to dollars, and then they invest it in high-yield assets like U.S. tech stocks.
So it's free leverage.
Exactly. When the dollar is strong and the yen is weak, it's risk on. It's a money printer.
And the election.
It's a snap election. The market analysis suggests that if the prime minister wins a majority, the Nikkei index is expected to surge 5 to 6%.
Wow.
And because the Nikkei and the Nasdaq are so tightly correlated, that surge in Japan provides the final hurrah for the U.S. tech rally.
So watch February 8th. If Japan spikes, the Nasdaq likely spikes with it.
Exactly. But remember, that's happening right before we hit the mid-February peak. It all lines up for that top. It's the last gasp of liquidity before the death zone.
Now, usually when tech is flying, when liquidity is loose, I assume crypto is having a party too. But the report says we are seeing extreme divergence.
This is a critical warning for crypto investors.
Yeah.
If you are holding Bitcoin thinking it's going to ride NVIDIA's coattails, you need to be very careful. While the Nasdaq is breaking out, Bitcoin is trapped. It's tracking a confirmed inside 4-month candle failure.
That sounds bad.
It is bearish. The structural necessity, according to the sources, points to a primary drawdown to $74,508, the previous year's low.
But we are seeing Bitcoin hover around 80K, sometimes popping toward 90K. It feels like it wants to go up.
The report calls the 80K to 90K range a chop zone. It warns you not to be fooled by a sympathy bounce.
Okay.
Basically, if the Nasdaq rallies hard, Bitcoin might get dragged up a bit, maybe to 98K, but it's a trap.
Why is it a trap? Why isn't it just a delayed rally?
Because of the relative weakness. Bitcoin is hitting resistance while the Nasdaq is making higher lows. The money isn't flowing there. And the scary part is the link to NVIDIA.
What's the link?
The analysis suggests that when NVIDIA rejects its highs after that February 25th earnings report, when the death zone hits, Bitcoin is expected to fall off a cliff in tandem.
Oof.
If tech corrects, crypto corrects harder because it's a riskier asset class.
And there was a specific short setup for Ethereum, too.
Yes, very specific. Entry at 3,477, targeting 2,628. The logic is that Ethereum is forming a double inside monthly candle, which usually resolves by sweeping the lows.
So to recap the crypto side, don't get FOMO from the tech rally. The correlation might actually hurt you on the way down.
Precisely. This is a period of rotation. Capital is flowing into the hyperscalers companies with actual earnings and buybacks, not into decentralized assets right now.
All right, let's zoom back out and look at the roadmap. It feels like we have a very clear script for the next 4 weeks.
We do. Step 1, immediate action. Stay long the indices as they pack these consolidation highs. The S&P 500 reclaiming the yearly open was the green light.
Step 2.
Early February, the melt-up. Focus on the laggards like Amazon and Meta. Let the stock buyback window work in your favor.
Step 3.
Watch for the Japanese spike around February 8th. If the Nikkei gaps up, that's likely the climax of the rally. Start tightening your trailing stops.
And finally,
the death zone. From February 20th onwards, you go neutral. You do not want to be holding the bag when NVIDIA reports on the 25th and the liquidity gets neutralized.
it's a trader's market. You have to be nimble.
Absolutely. The market isn't crashing right now. It's reloading for higher prices in the long term. But this intermediate correction in late February is designed to flush out the complacent money.
Before we wrap up, I noticed a final provocative thought in the notes regarding precious metals. We didn't touch on them much, but the report mentions silver and gold are in a mania phase.
Yeah, this is something for the listener to really mull over. The report notes that gold and silver are in a parabolic rally, the kind that often ends with a 20% drop in a single day.
Wow.
But here's the bigger question. If the market of 5 stocks is sucking up all the global liquidity and we have this artificial support from corporate buybacks, what happens in March?
When the buybacks stop.
Exactly. When the cash cows stop buying their own shares to pay their tax bills, and if the precious metals mania collapses at the same time, are we looking at a simple, healthy correction? Or is the death zone actually the start of a liquidity vacuum that breaks that wait-and-see capital?
That is a heavy thought to leave us with. The idea that the only thing holding up the sky is a corporate buyback window that closes in 4 weeks.
It definitely makes you want to double-check your stop losses.
Indeed. Well, thank you for guiding us through the charts and the death zone. We will be watching that February 8th date very closely.
My pleasure.
And to our listeners, good luck navigating the rainbows and the hyperscalers. See you in the charts.